What if I told you that a single piece of paper you signed at 18 could be quietly draining your bank account a decade later? Across America, millions of 26-year-olds wake up every month to the exact same phone notification. Another student loan payment is due. You are trying to build a life. You're juggling rising rent, higher grocery bills, and maybe a car payment. But sitting right in the middle of all those basic living expenses is a heavy, mandatory minimum payment that demands your attention every single 30 days. So you do the right thing. You make your payment on time. Then you do it again the next month, and the next. But when you finally check your overall loan balance, it barely moves. For many, it feels like no matter how hard you work, you are running on a financial treadmill. This financial claustrophobia is the mathematical result of following the default rules millions of Americans are assigned by mistake. If you're consistently sending in cash, what mechanical force is keeping that principal balance so stubbornly high? The culprit is the government's standard 10-year repayment plan, working in tandem with a silent wealth killer called daily compounding interest. Every day your balance sits there, it breeds new debt. Take a look at how your monthly payment is actually sliced up. When you send in your money, 80 to 90% of it is instantly swallowed by the interest that accrued that month. Only a tiny sliver at the very top ever touches the actual principal you borrowed. When you stretch this out over 10 or 20 years, this heavy interest structure artificially drags out the lifespan of your loan. You end up paying thousands of dollars in excess interest that completely dwarfs the original cost of your education. Relying on the default payment schedule ensures your debt survives as long as possible, keeping you tethered to a balance that would have disappeared years ago under a different strategy. Before you can attack this debt, you have to run a blind audit of your loan portfolio. You cannot fight an enemy you haven't identified, so you need to know exactly who you owe. The first step is separating your federal student loans from your private ones. Federal loans come with built-in government protections and flexible repayment options. Private loans are strictly commercial products that carry far less flexibility and a lot more risk. As you sort these out, there is one metric you must uncover: the interest rate on each individual loan. This single number dictates the exact speed at which your debt is multiplying behind your back. Staring at one massive, terrifying total balance will paralyze you. But breaking that total down by loan type and interest rate turns a vague financial nightmare into a highly solvable math equation. Of course, calculating aggressive payoff strategies feels impossible if your current minimum payment is already eating up your entire disposable income. You can't get ahead if you can't even afford to breathe. This is where income-driven repayment, or IDR, becomes a crucial tool. It is a systemic federal program designed specifically to detach your monthly minimum from the total size of your debt. Instead of forcing your fixed loan amount through a rigid standard pipe that creates a massive payment, IDR calculates your bill based on a percentage of your actual discretionary paycheck. The payment dynamically shrinks to match what you actually bring home. Many of these specific federal plans even include long-term forgiveness clauses. If you remain compliant and make your adjusted payments for 2 decades, the remaining balance is completely wiped clean. IDR doesn't magically erase the debt in the short term, but it stops the immediate financial bleeding, securing the vital psychological breathing room you need to stabilize your life. Once your monthly cash flow is secure, it is time to pivot from defensive survival to a proactive, offensive attack on the principal balance. There are 2 proven frameworks for this. First is the snowball method. Here, you take any extra cash and throw it entirely at the smallest balance, ignoring the interest rates. Closing out small accounts early provides the visible progress needed to keep going when the total debt still feels overwhelming. Then there is the avalanche method. This strategy ignores the loan size and relentlessly attacks the balance glowing red with the highest interest rate. You destroy the most expensive debt first for maximum mathematical efficiency. When we compare the long-term outcomes, the avalanche method hits 0 faster and saves you the most capital over time. But the snowball method creates the early wins that prevent burnout during the grueling first year. The best strategy is the one you actually stick to. For some, the logic of interest rates wins. For others, the dopamine of a closed account is the only thing that ensures the extra payments keep happening. Implementing these strategies changes how you interact with your money. You stop reacting to the loan servicer's demands and start dictating how and when your money is used. The stakes here are incredibly high. Every single dollar you save in unnecessary interest is capital you can redirect toward buying a home, starting a family, or simply sleeping soundly at night without financial dread. So here is your 30-day challenge. Log into your student loan portal, map out your individual interest rates, then commit to either the snowball, the avalanche, or an IDR method before the month is out. How much student loan debt are you working to pay off? We'd love to hear your goal in the comments. The student loan system thrives on complacency, keeping borrowers paying minimums forever. But you can outsmart it by refusing to play by their default rules. Student debt does not define your future. Financial freedom and lasting wealth are never built overnight. They are engineered, step by step, one deliberate, mathematically sound decision at a time.